Thanks so much for being on the panel today, Lori and Jean. It's so fabulous to see you. Allow me a moment to introduce you. You can hear me? Okay. Lori is a partner with Springboard Growth Capital, which provides visionary women founders with capital to build market-leading consumer brands. And Springboard Growth Capital has a number of investments that you might recognize: Real, ClassPass, Hint. These are, household names almost, right, at this point. So congratulations on having a terrific portfolio. And it's such a pleasure to have you with us here today. And Jean is the chairman and CEO of MediaShares that provides advisory for companies that are interested in exploring various innovative ways of fundraising. And Jean, my understanding is that you direct them to the best possible place, but crowdsourcing is one of the strategies, crowdfunding, is one of the strategies that you're very deeply involved with.
Yes.
So I am going to give you a couple of minutes to introduce yourselves, please, and add anything from your background that you find pertinent. And after we're gonna, go through with the introductions, I'd love to delve into crowdfunding first. Then we're gonna go to VC, and we're gonna end up with the comparison between crowdfunding and VC. Because there are many things that obviously there are pluses and minuses to everything, right? So we're gonna go over that and then open it up for questions, because I want everyone to have an opportunity to at least have maybe 10 minutes for Q&A. If that sounds good, Lori, we'll start with you. Please go ahead.
Sounds great. Yes, nice to be here and join everybody, albeit from a different state, but I'm feeling the energy in the room. And I've been investing in the consumer sector for 30 years now. For the first 20, I invested in public consumer companies. I was at a large asset management firm, Delaware Investments, for a good part of it, where I was a portfolio manager and oversaw about $4 billion in assets. And while I was there, I invested in small and mid-cap growth companies, those with market caps of 1 billion-ish as they were going public. I'd meet with them as they were starting their life in the public markets, and I would stay with them as they grew into mid-cap companies and got to that $10 billion market cap or so. Investing in consumer companies started to experience a seismic shift about 10 years ago, with the wide-scale adoption of smartphones and social media. And I know this is a smart crowd. I don't have to elaborate too much on that. But the legacy companies really had a difficult time adapting. So I then spent 2010 to about 2015 at a hedge fund that I co-founded, in which we were able to capture alpha by both shorting these legacy companies and continuing to look for these quality growth companies. But as the next generation of consumer-facing companies started growing and they were staying private longer, I pivoted into growth equity investing. And it was and it still remains to be, a very exciting time. Then it was these digitally native companies that were able to achieve a scale in a matter of months, what used to take company at least years to get to. Just pioneering a new way to do business and cutting out the middle agent and building these direct relationships. And that is where I wanted to spend my time. I joined Springboard Growth Capital, which Julia already explained. We invest growth stage capital in women-led companies. It's an interesting area that doesn't have a lot of participants, given the scale needed to participate, but I will hold off on that until we get into the larger conversation around venture capital investing.
Wonderful, thank you, Jean. Go ahead.
Can you hear me okay?
Yeah.
In 1998, I ran around telling everybody it's all the funding is going to be on the internet. I called it fan financing. And I spent the next several years and about $1 million of my own money trying to get financed for a company that would do fan financing. And then in 2006, Kickstarter called it crowdfunding.
Yeah.
In 2010, I did a presentation in Silicon Valley to an audience that included Elon Musk and all the venture capitalists in Silicon Valley practically, and talked about how this company was going to do crowdfunding, equity crowdfunding. Now, this is before the Jobs Act. And then in 2012, in the Jobs Act, I could finally do what I'd been talking about, because they made it legal to actually solicit funding online. And so that's what MediaShares does now. We help companies get funding on the internet. Mostly it's called equity crowdfunding, but that encompasses basically any funding where you go out and advertise your offering on the internet. Now it's done mostly on platforms like Start Engine, Seed Invest, WeFunder, and now there's a new thing where you can do it on your own website even, and a lot of companies are doing it on their own website with it being managed by a broker. Well, what MediaShares does is we walk companies through the whole process if they don't really know much about it. And we help them everything from, we help them in every way, including their corporate governance, through their marketing.
Right, that do a small table.
I think Jeff needs to mute himself there. And we have to, we help people through the whole process.
Or just take this out. Well, and put it here.
And that's what MediaShares does.
For anyone who is currently online, would you kindly mute yourself?
Ask them if they have like a round.
Hey, can you mute
I'm gonna mute him, yes.
Yeah, thank you so much. Sorry, guys. Okay. Jean, why would you think a firm would gear towards crowdfunding versus a VC? Is it the fact that they're pre-revenue, they have no way of attracting VC attention? What is the profile of a company that you would work with, and what are the main reasons for it to turn to crowdfunding?
Actually, it's a company at any stage.
Okay.
It can be a company that really needs to get money from Uncle Charlie, and they have nothing. They have an idea, and they can actually post that idea on a platform and actually get money for it, whereas they might not be able to get that money from a VC because they don't have any traction and they only have an idea.
Right.
So that is a possibility for a company to get money with just their idea, but it goes all the way through to Regulation A, where companies are getting 20, 30, $40 million online. You can go on various platforms and even see on some websites where they're getting under Regulation A, which allows you, by the way, to raise up to 75 million from non-accredited investors. You can actually get money, large amounts of money, on these platforms, and even go forward with a listing. A number of these companies are even listing on NASDAQ. So it runs the whole gamut of from a complete startup with needing seed capital all the way through to a company with considerable revenues and growth needing growth capital. So it's pretty good. The advantage to it is valuation. You can very often, we can talk about this further, but very often you'll get a much better valuation from the crowd than you will from a venture capitalist.
Thank you. Before we delve into valuations and exits and other things where we compare VC with crowdfunding, Lori, just a few questions about some of the very interesting things that are happening with women-led companies. I want to ask you, first of all, what is the % of venture funding that currently goes to women-led companies, and how has this changed over time?
No, it's a little bit of a jaw-dropping stat, so I'm just preparing everybody. It's been, of all the venture funding each year, about 2 to 3% of that goes to women-led companies. And this looks back over the past 20 years. It's bounced between that 2 and 3% level. I'd like to even say within that it's been trending in the positive direction, but it's not the case. It got to its highest point in the immediate aftermath of the Me Too movement, but last year it was at the absolute bottom of that range at 2%.
And how did this company perform versus a peer group?
It's interesting because sometimes I'll start talking about women-led, and it's clear that I'm about 10 or 15 minutes in, and people are looking at it as a little bit of a nonprofit case, and it just couldn't be further from the truth. Large studies of female-founded teams show that they outperform the all-male teams by 63% in terms of value creation. They exit faster with a median exit on female-founded companies of 6 years versus 7 years for male-founded teams. And at the time of exit, they're growing faster. Female startups are also more capital efficient. They raise 45% as much as male startups, yet they deliver 2.5 times more revenue per dollar invested. And the final stat that I've come across over the work that I've done is that if you look at VC firms that have increased their funding into women-led companies, they saw 1.5% increase in overall fund returns each year and had just about 10% more profitable exits.
And how do the deal dynamics differ?
Well, as you could imagine, given that there just isn't as much competition for it and investment, the median deal size and the pre-money valuations are about half for women-led companies that they are for all-male teams. 2020 stats show that the median deal size was 1.6 million for women-led versus 3.7 million for all-male, and pre-money valuation of 12 million versus 25 million.
Are there more female decision makers in the venture community? What's happening on the investment side?
So there has been a gradual increase in there over time, where it's up to about 15% of decision makers in the venture community are women now. Of that, about 5% are partners. Of the partners at venture firms are women. Again, pretty small number, but these at least have been moving in the right direction. Yet 2/3 of venture funds that are of some scale, that have $25 million or more in AUM, don't have a single female partner. So a long way to go there still.
Does having women as investment decision makers make a difference?
And we get that question, and it seems a bit obvious, but the numbers are more striking than one would think. So having a female decision maker around the table is 4 times more likely to invest in a women-led company than a room that did not have a woman as part of that decision process. So you could just see how that ripples out. The actual numbers are, if you look at any given venture that's being pitched, 15% of the time, if it's women-led, an all-male team will invest versus 58% of the time if you have a woman in the room. And we get it, right? I mean, VCs overwhelmingly invest in founders and teams that look like them and in products and services that they know and understand. So it makes sense, but the numbers, just given there's such a massive misalignment, we need some radical innovation in this space.
Jean, I'm going to pose the same question to you because you've been speaking to Wall Street for many years about women investors, etc. And what is your view on that?
Well, it's very true that women make better investors. You can look at it statistically, and you will find that women are much more careful. They're much more studious. And whenever they do invest, they have better returns. So, and I happen to tell you a very bad story. I talked to a lady who was presenting to a very prestigious venture capital firm in Silicon Valley. And she said when they finally got her time to pitch, the guys in the room all looked at their phones the whole time. They didn't even give her a good, honest look at what she was doing. And so my question would be, why is that? Is it because most women's founders are thought of as dealing with women's products or something? I mean, they don't have big machinery that they're pitching. They're pitching, cosmetics or something. Is that the reason? I mean, why would we be so biased against women founders when in fact they do better, as Lori said? Statistically, they do much better. It seems to me like every venture capital firm would be kicking all the guys out of the room and say, please, let me see the women founders. I mean, what is it that's the big bias against women founders? I don't know. I honestly don't know.
So we have 10 minutes left, and I want to go a little bit into exploring the crowdfunding versus VC. Okay.
Sure.
So, Jean, in your opinion, what are the main differences? You talked about valuations a little bit. Can you follow up on that?
Well, first of all, if you know a VC and he'll give you the time of day and he's a friend of yours, or you're introduced to a VC through a very highfalutin partner who's a friend of his or something, then you can get a decent time with him. That's probably a very good way to get money, because crowdfunding is a lot of trouble and it's expensive. You have to spend a lot of money to get funded with crowd. You'll spend 10% of your money and then another 10% for the platform. So you'll spend 20% of the money you get to get it. And you would say, well, why would on earth would I ever want to do that? Well, the reason is because you can get a valuation that a venture capitalist will laugh at. There was a company that went on Start Engine. They had a new way that they claimed to make a new way to make solar cells faster, cheaper, and produce more electricity. And they had a very good story with graphics and videos and everything, and MIT advisors, and they got $5 million on a $200 million valuation, and they never made a dime. They didn't even have a product, as a matter of fact. They were going to be doing this. And so with that kind of track record of being able to get money at an extraordinary valuation, and they got about an average of $1,200 from over 4,000 investors. Because people look at it, the crowd looks at it and goes, wow, that's cool. Yeah, that's the solar. Yeah, that's going to go. And a lot of people don't know what the word valuation means. They don't know how to analyze a company. So you get money it's dumb money. Whereas if you got that money from a venture capitalist, somebody like Lori that knows what they're doing, you'd also get good advice, see, and help. I think you should go see Bill over here on Wall Street. He's got, and they can help you and guide you. Whereas the crowd, unfortunately, mostly is dumb money. And the exits are not good in crowdfunding. I've seen companies, my last two companies, I got them acquired because they didn't have much other help to go beyond that. One company, they got enough money. They did not get enough money to do what they said they were going to do. And so I made them give all the money back to the crowd. They had to refund everybody that had invested over $200,000 because that wasn't enough to do what they said they were going to do.
Wow.
But I did get them acquired. So, they did have an exit, but a lot of these companies that are doing crowdfunding they're not getting a proper exit. And they're not doing proper governance either. I
just want to cut in. We got like 15. I'm actually adding China to this panel because I forgot. But we have about 15 more minutes. But yeah. So I just want to just break this down into who can get VC funding and who can't. Because when I think about women, companies that get funding, there are dozens of women-led VC firms out there, and some women partners at different funds, and they get funded, and they will fund businesses, and they have very rigorous. All these people are former bankers. They've got very rigorous approaches, right? So there are women who can get funded. There are men who can get funded. Most of the men who get funded in VC are under 35 years old. If they're in tech. If you're in healthcare, you're under 45. Just the nature of the game, right? It's very difficult. So to me, aren't all those other people, they had to go through alternative funding mechanisms or crowdfunding or Reg A? Jean, your thoughts? I mean, because it's everybody else, right?
It's easy to get money. It's easy to post your offering on crowdfunding. You can go on WeFunder and put your offering up there. And as soon as you get 50 grand, they'll even file the documents for you. And they have a lawyer on staff who will help you walk through everything. So it's a piece of cake. If you got something that looks interesting or looks cool, like a flying motorcycle or something, you got something cool, you post it on there and you can get money. Everybody goes, wow, that looks cool. Yeah, they're going to make money. And so If you've got a real deal, you need to go to a venture capitalist, I think. And that's sometimes hard to do. You need someone to introduce you, really. You can't just send them an email and expect to get the time of day from them. So it's hard to get
What
VC
percent
money.
of deals that are crowdfunded later get VC funding?
I don't know the statistics on that. I would think, now they have a thing called an SPV with a crowdfunded offering where all of the investors, usually, not every time, but usually all of the investors are rolled into one investor. So they have an SPV like the Facebook did to avoid the public offering for a while. They'll have one investor or one entity that holds all the shares of everyone. And so they'll do that in crowdfunding now. So you don't have to deal with 5,000,
Right, so I think I was reading that 25% of the VCs out there went to Wharton, Harvard, Stanford, or MIT, and that 50 or 45% of the people they fund went to Ivy League or Ivy League comparable schools. But that's not even it, because they also fund guys who go to the top Russian technology schools. They fund a bunch of guys out of IIT. Right? So that's 75% of all the people that get VC funding. The other 25% that are left, that's a small portion for the rest of the world, right? So people have to find alternatives for getting funding, and obviously there's this valuation asymmetry between the two groups, right? And you got to figure that out, and that's where there's this huge gap.
There's a huge disparity in the valuation between the two. A venture capitalist knows how to analyze a deal usually. And like you said, all those guys have an education, and they know how to look at your deal and they know how to look at you, they know how to analyze the team very well. A crowd won't, very often they don't know how to do that as well. And so that's an advantage for the entrepreneur, but it's a disadvantage for the investor.
Let's pose the same question to Lori. Lori, what is your view?
Right. So people might know women that have funds, but they're not of scale. I mean, if you look at PitchBook, there are 900 funds that are listed with over 100 million in AUM. Of those, 7 of them are founded and completely led by women, and 29 of them have women as the majority of decision makers. So it is a tiny piece. So yes, we might all know people, and I'm one of those people, but it's such a tiny, tiny minority. And then, certainly when it comes to venture, to follow up on what Jean was saying, it's when you can attract the venture funding, there is some great expertise that comes with it. And having shifted from the public market space, it was very different. It was a bit foreign that, when a stock's out there trading, it's always going to take the highest bid. But I've seen it with companies that I've been involved with. They won't necessarily take the highest term sheet. It's really the ultimate goal is what the end game exit will be. And we've picked firms to align with that were not the top bid, but that we knew could provide some additional great value add on the journey until the exit. So it certainly is an interesting difference from the public markets and an important aspect of consideration.
Should we open it for questions?
Absolutely.
Just in case?
Yeah.
Are there any questions from the audience, both online and present?
I think it's very interesting. I'm sorry, Eric, did you want to?
I just had a question about Springboard, but are you accepting investors, and how much money do you manage right now?
So our model, and I'll go into it, we're an SPV model. And the thought was that there's this tremendous white space in growth stage financing for women-led companies. Women have had some success at the earlier stage, but as I just mentioned, not getting over 100 million, and arguably you probably need 200 million to invest in this space. So we've done it on a deal by deal basis. We start an SPV for each investment vehicle. And one of the things we love is the democratization of the access to this growth stage asset class. And about 40% of our LPs are women. So we obviously take money from both sides, but are well above industry norms as it relates to that. We don't have a stated investment minimum. There are some practical applications around that we could talk offline about. But we've really been very successful in bringing people in a wide range of check sizes that are excited at the opportunity to invest in a specific company that they believe in. And, you know, many also like the added benefit of backing female-led companies.
Any other questions? I have a question.
Yes, please.
Can I? Jean, you have a very interesting white paper where you go into,
I just posted it in the chat.
so you talk about the fact that now, in addition to going onto a platform like republic.com and wefunder.com, etc., you can also start fundraising from your own website. That
Yes,
seems to be a relatively recent thing. Can you talk a little bit more about
Sure.
that and the pros and cons?
sure. The pros are is that you know, I compare it to a good-looking girl going to the dance. There's a lot of other good-looking girls there. And if you have an offering and you post it on a platform, you post your offering on a platform, there's a lot of other offerings there. And so you post your offering for.
It is in his white paper, I read it. Yeah, it is in the white paper.
So anyway, you can do the offering on your own website, because you're going to have to drive traffic to wherever your offering is. If your offering's on Start Engine and you drive traffic there, they go, oh, look at that, a flying motorcycle. And so, you know, you're diluted by all the other offerings. So if you drive traffic to your own website and there's the offering, you have a much better chance of not being diluted from the other offerings. So there is a huge advantage to that, to being able to be on your own page. Now, that said, when you put your offering on Start Engine, they've got 900,000 investors on their platform. So it's kind of a trade-off. But if I'm going to spend 20% of my money to get the money, I want them to go to my page where I can have other stuff about me in my offering, you know? So there's a real advantage there. But the real thing is that the only way to do that, by the way, is to have a broker manage it. You have to have a FINRA broker that manages that offering on your page. And there are a number of companies that do that now, that will manage that offering on your page to keep you in SEC compliance in all aspects.
Yeah, so Jean, outside of your fantastic metaphor, the only thing I want to talk about here, though, is that, and I think you're trying to get to the point, is that people don't understand that, like, anything that you float as an offering, ultimately there has to be a market maker who's going to create the value of your equity that you've floated out there, right? So I would say, I mean, so you're talking about, hey, crowdfunding companies get more valuation than venture funding companies, at least at the initial stages, right?
That's for sure. That's for sure.
Include that you had to pay 10% in fees, you know, another 10% in legal fees, 20% in marketing. I mean, there's a lot of other stuff that's part of the package, right?
Mm-hmm. Yeah, well, if I ask Lori, if I've got a pre-revenue company with no product yet, and you give me $5 million, what percentage of the company you're going to want? You're not going to want, you're going to want more than 5%, right? So that's the trade-off.
The marketing aspect, and you're talking about, you know, channeling things directly to websites.
Yeah, you'll get a huge valuation. And not only that, the money that you spend in marketing also builds your brand.
Of course,
So
they see your product, they see your
they see your product and build your brand. So you mean I'm going to spend $10 million to get $50 million and 20% of the money? Yes, but I also did $10 million worth of marketing about my company. So you essentially get 2 for 1 in that kind of deal.
MediaShare is mind share, right?
I don't know. You know, basically what we are is a firm that walks people through the whole process. There are not many firms out there that know as much about this as we do. I think I can say that without being too arrogant, but we really know a lot about it. We know all the different platforms. We can call them up and talk to them. We own all the different marketing companies. I can tell you which ones we had a problem with and which ones are really good. You know, all the attorneys, all the marketing companies, all the, you know, the accountants. Because of my experience speaking on Wall Street, I got to meet all these people. You know, I tell people that I know everyone and their dog's name, as we say in Georgia.
Lori, can we get some closing comments from you in terms of what, you know, what you're doing and how people can reach you, et cetera?
Sure. I was actually just jotting a note that we had discussed. Please reach out to us on LinkedIn, probably the best way to get things going. And, from there, just continues to be an exciting time, certainly investing in the consumer space. We're getting some market, shifts at the current time, which could turn out to be a nice opportunity in the venture space to have some of the valuations come back down a bit to a more reasonable level. And, I continue to be very passionate about finding these incredible female founders that are already at the growth stage, raising rounds that are $25 million and up, have at least 10 million in revenue. So there's a lot of de-risking that has already occurred before we make these investments. And so it's, you might not get the crazy venture style returns, but it's still a very strong returning asset class that's still to be captured at this stage.